Hey guys, last week was a pretty good week in the market. I'm pretty stoked about where the portfolio ended up. So I want to share that with you today, as well as go through three stocks. One stock is a stock that I do not have in my portfolio that I plan to add to it at some point. Another one is a stock that is in my portfolio and I'm looking to add shares in. And then the third one is a stock that I want to give a caution on. So if you want to hear all of that, stay tuned. Hey guys, Kevin Burgess back again with another video. Today I want to talk to you really about two things. One is about the portfolio and the performance last week. Pretty excited about what we saw last week. I can't wait to go through this. We're going to see the portfolio hit a new milestone. And then we're going to turn to looking at three different stocks. One stock is the stock that I'm looking to add to my portfolio. Another one I already have and I'm planning to add more depending on where the price goes. And then thirdly is a stock that I've heard several YouTube videos on, and everybody is buy this stock, buy this stock. I'm not so sure that's a stock that I want to be adding to my portfolio. Obviously, I'm not a financial advisor. You got to do your own due diligence about what fits in your portfolio. I'm just here sharing with you my journey so that you can hear my perspective. And if you like it, you can keep it. If you don't like it, you can throw it away. That's the beautiful thing about YouTube. This advice doesn't cost you anything, and it's probably worth exactly that. So if you like videos like this, if you could give me a thumbs up, I would appreciate it. It lets others know that the content in here is worthwhile and worth listening to. And also, if you're not a subscriber, I'd love for you to subscribe to the channel and join me in this journey as we seek to grow our dividend growth portfolios. So if you're new to the channel, I have three different portfolios that I go through. One portfolio has the purpose of dividend income. So I'm looking for stocks that produce a higher yield, some growth, but a higher yield. The second portfolio is a growth portfolio that looks for higher growth, maybe less yield. It is really more for a medium term, maybe 10, 15 years out. And then I have the third portfolio, which I just started last month. It's called the Dividend Snowball portfolio, and this portfolio is designed for someone who has 20 plus years before they retire. So with that out of the way, let's get started. The portfolio update as of the end of the day on August the 12th, the portfolio ended up over $900,000 for the first time ever. That's a milestone. I'm excited about that milestone. So we're at $907,686.07. We got about right at $500 worth of dividends in that week, $333.54 in the dividend income account, and $166.34 in the dividend growth account. And you can see the market change here. We've got a market change. I'll talk about the percentages. A market change of 2.3% for the dividend income account, 2.4% for the dividend growth account, and 2.4% also for the dividend snowball account. So with that being said, the performance for the week overall was 2.4%. We compare that to the S&P 500 performance, which is 3.3% for last week. So we trailed the S&P by a little under 1%, about 0.9%. So it might be worthwhile to talk about maybe which stocks performed well and which ones didn't. So let's look first at the dividend growth portfolio. Again, this is the medium term, maybe 10 to 15 years out. So you can see that some of the best performers were Aflac, EOG Resources, Apple, and Best Buy. Stanley Black & Decker was a good performer last week. Then you see the one who didn't perform well was Johnson & Johnson, and it went down about 3.6% on the week. It's down 6% over the last month and about 1.4% over the last 6 months. So it is not performing as well as one would hope, but it is certainly a stock that I want to have in the portfolio. I'm certainly not going to get rid of that. But I think that, as well as the semiconductor segment, caused us to be a little bit below where the market was. So when I then look at the income portfolio, obviously a different set of stocks. I've got Prudential was up 9.3%, which was pretty good. Then we have KMI, which is up almost 7%. Fidelity National Financial is up nearly 6%. So I've got some stocks that are just really doing well on the income side. On the flip side of that, I have Main Street Capital Corp, who issued some more shares last week, it's a business development company, so that is what they do, and we should be used to that. But obviously some investors are not, and it went down about 3.5%. Then we have AT&T and Verizon also were down. Well, AT&T was down, and then Verizon was up a little bit, but not much. So those stocks were part of the reason that this portfolio didn't perform up to the S&P 500. So let's take a look then at the dividend snowball portfolio. I know a lot of younger investors are interested in this. You can see that for the week, we have Starbucks coming in at the top slot, 3.6%. Very close behind that is Google at 3.58. SCHD was 3.52. Microsoft was 3.15. And then we had this semiconductor ETF, which only brought in about 0.61% for the week. But other than that, it was a great week overall. Okay, let's flip back over to the portfolio update. So for the week, we've already talked about the 2.4% performance versus the 3.3% in the S&P 500. But now let's look at year-to-date. Year-to-date, the portfolio ending balance is $907,686.07. Dividends, we've gotten $15,510 so far this year. The options transactions that I've done were $450. I've put about $125,000 in since the first of the year. And then the market change year to date is back in the green for the first time in a while, so I'm excited about that. So take a look at this, $9,883.49. So we are now positive year to date by 1.2%. Compare that to the S&P 500, which is down still 10.8%. I have added 2 columns down here, and I want to explain that really quickly. I have a dividends and options return. So when I look at this market change, that is simply the change in market prices for the portfolio. And it's important that I look at it that way because that is the way the S&P 500 is calculated. It does not include dividends or anything along those lines. So comparing the market change in the portfolio to the S&P 500 is an apples to apples look at the portfolio. I now want to add to that the dividends and options and get a total return on the portfolio. So instead of 1.2% on a year-to-date basis, the total return, which includes our dividends and options, is actually 3.1%. So I'm pretty excited about where the portfolio is. Let's go ahead now and look at these stock picks that I wanted to share with you. The first one, and this is the one that I do not have in my portfolio, but I do plan to look harder at this stock, is Robert Half International. They're a human resource and employment services firm. They have a dividend yield of about 2.09%. Very safe dividend safety score, 96 according to Simply Safe Dividends. Looking at their dividend growth, we can see that over the last 5 years, they have grown their dividend on average by 12%. And the last increase was in February of 22 for 13%. You can see the consistency because in the last 10 years it's been 11% per year. So this is the way we want to see this chart, kind of up and to the right. They've issued dividends now for 17 years and also have grown them for 17 years. So the way Simply Safe Dividends looks at valuation, they compare the current yield and the current PE ratio to the company's average 5-year dividend and PE ratio. And in both cases, this would tell them that this particular stock is undervalued. But let's look at some of the numbers. So we see an earnings payout ratio pretty consistently, in the low 30s to upper 20% range. We see that in 2020 it was 50%, but that was during the pandemic. So I would just not look at that number. but you can see that this is a pretty low earnings payout ratio. Looking also at the cash flow payout ratio, it's very similar, and we love to see that as well. So we've got a good payout ratio for both cash and earnings, giving them the ability to continue to grow the dividend over time. When we look at earnings, we see the earnings going up and to the right, which is kind of exciting. We also see free cash flow up and to the right. So these are really good metrics for Robert Half. When I'm looking at shares outstanding, I like to see this coming down, and it is doing that. They were at 130 million shares in 2012, and now they're at 111. So that's, pretty good performance there. Look at their sales. Their sales were up and to the right. One of the most impressive things to me about Robert Half is the return on invested capital. So when I look at this, they are producing a return that is really adding value. Over the last 12 months, it was 58%. It's been as low as 23%, but that's still really good, even though that was in the year of the pandemic. So typically they're in the 40 to 50, almost 60% range. Very impressive return on invested capital. One of the things I look at is debt. You can see that the net debt to capital is 0. One thing to point out here in Simply Safe Dividends is their interest coverage ratio is very important. We want to make sure that the company has the ability to cover any debt service that it has. And it says here 4.57. But and then it says above 8 is our preference, but that 8 is way down here. So how in the world is 8 less than 4.57? You have to read closely, because the interest coverage, because it's so high, is in the thousands. So this is actually 4,570 times, not 4.57 times, 4,570 times, which is a lot bigger than 8. So well covered on their debt. Let's take a look at Morningstar and see where they have them valued. They have them valued at $88. Their last close was around $82. They're pretty fairly valued, maybe a little bit below fair value. On Fast Graphs, you see that they have come down here recently, and the major reason there is potential for recession. This is the max chart. I'll go ahead and shrink this down to about 8 years. We can see that it's now, I believe, in territory to buy. I don't know how far it would actually come down, but it is certainly not overvalued in my opinion. So one of the things we have to consider are the macroeconomic issues with inflation and where the economy is heading in the future, and whether it's going into recession. This could impact a business like Robert Half, but I believe in the long run it's going to be a pretty solid business to get into. Got to do some more due diligence. I would encourage you to do your own due diligence on Robert Half, but it's looking pretty good from my perspective. So a stock that I actually own in the portfolio that I'm planning to add some more on is Stanley Black & Decker. You can see the dividend safety rating is 90. The dividend yield is pretty high right now because they're going through a bit of struggle. But with a 3.2% yield, that's pretty good yield for a dividend growth stock. You can see that they have paid dividends for 54 years and have grown them all 54 years. This last dividend was a very slow dividend growth, 1.3%, but over the last 5 years they've grown it by an average of 6%. According to Morningstar, they value them at $141. And if I look at Fast Graphs, you can see where my purchases have been. I guess you could call this catching the falling knife. I did buy this past week at the price of $94.20. It's up now around $100, $99.86. So it did a rebound this past week. But if it were to drop back into the lower 90s, I will be adding more Stanley Black & Decker to the portfolio. For a couple of reasons. One is I think long-term they are a good investment, but then secondly it would bring my average cost down. So the last stock I want to share with you is not one that I would recommend. It is one that I'm hearing others on YouTube recommend. So this is going to be a little bit different, right? I'm going to share with you a different perspective on this stock, and if it's one that you're interested in, just make sure you do your due diligence and pick it because it fits in your portfolio and has a purpose. But I wanted to offer a different opinion on this particular stock. And that stock is Huntington Ingalls Industries, ticker symbol HII. It is in the aerospace and defense industry. The dividend yield is 2.05%, which is pretty low for a dividend growth stock. It has grown slowly this past year. So the last 5 years it's grown by 17% per year, which is really, really good. It has grown its dividend and paid a dividend for the last 9 years. So it doesn't have a long track record, but 9 years is pretty decent. And according to Simply Safe Dividends, it looks like it may be undervalued according to their dividend yield and forward PE ratio calculation. So let's look at some of the financial numbers. The earnings payout ratio looks really good. It's down in the high 20s, low 30s. Its free cash flow payout ratio is a little bit higher, but not too much higher. Look at the earnings per share, pretty flat over the last, let's say, 6 years. Free cash flow, pretty flat over the last 6 years. Their shares outstanding looks pretty good. They are reducing their shares. They've come down about 10 million shares in the last 10 years. Their sales are growing, but they're not growing at a very fast pace. Their return on invested capital historically has been pretty high. It's been in the mid-20s. It's now down around 10 to 12%. This is pretty close to their cost of capital. So in my opinion, they're not adding a lot of value at this point. Their net debt to capital is about 0.51, 0.4 is where we typically would want to see them, 0.4 or below. Their interest coverage ratio also is a bit concerning, although it's not terrible. It is below 8, which is what we look for in companies like this. When I look at Morningstar, they have this company valued at $226. Its close was $230.46, so it is a bit above its fair value. I would expect that we would want this to come down a bit before we would invest in it. But if I look at it on a 7-year view, I can see that it is currently priced at above fair value according to Fast Graphs. So I would expect that I would want to buy it in some places like here, where it's pretty far below fair value. It's not a terrible stock to own, but and if you bought it here, you could probably expect it to go up over time. And let's take a look. If you bought it today and it was valued somewhere around here, then it would net you out about 13.5% per year. But there's probably a better time to buy this stock, and that would be when it's back down below, either below the orange line or below the blue line would be optimal. So those are 3 stocks that I've been looking at this week. Robert Half International, looking to add that to the portfolio at some point. Stanley Black & Decker, if it drops back into the low 90s, I will be adding that to the portfolio. And then Huntington Ingalls Industries. I just don't think the price of that one is low enough to add to the portfolio at this point. You can make your own decisions on all of those. Please do your own due diligence. And let me know in the comments what you think about those 3 particular stocks. Looking forward to hear what you have to say. So with that, I'll see you on the next video.